Before we start, a warm welcome back. If you watched my last video, the one exploring how gold and silver behave during stress, we focus on signals, inventory flow, and the difference between metals that are stored versus metals that are consumed. Today's video takes a different direction. Instead of asking what triggered the recent spike, we are asking why gold's strength in 2026 may be structural, not temporary. If my last video was about what pushed metals up, this video is about why the move might last longer than most people react or expect. And if you're new here, hello, and this is Think Wealth 6789. I work a normal 9 to 5 here in Singapore, and this channel is where I break down markets clearly and calmly so even busy people like you can stay informed without the noise. Alright, let's begin. When gold breaks records, the usual reaction is the same. It's too high, it must fall soon. But every now and then, the pattern shifts, not because of hype, but because the underlying logic of the financial system is changing. Today's video is about that shift. We are going to unpack the data-supported reason on why gold remains strong in 2026 and why many experienced investors believe we are closer to the beginning of the cycle than the end. Let's anchor this and in what actually happened this week. On January 16, gold briefly cooled after hitting new highs, but the pullback was tiny compared to the upward trend. By yesterday morning, Monday, gold crossed $4,660 and silver pushed above $92 during Asia trading. This wasn't driven by panic, it was driven by flows, institutional positioning, and a global shift towards safe haven asset. And this leads to the bigger questions. Is this just volatility or is something deeper happening underneath? Most people track gold through headlines, interest rates, politics, or market fear. But price is the last thing to move. Before price changes, something else changes first, the behavior. What central banks do, what wealthy families do, and what institutions accumulate quietly in the background. That's what drives long-term cycle. 2026 is not following the old playbook. Historically, gold moves mainly on inflation and rates. This year, the drivers look different. The geopolitical uncertainty, currency debasement concern, supply tightness in physical markets, institutional accumulation, weakening confidence in long-term debt sustainability are what causes the gold to rally. When multiple forces align, you don't get a short-term trade. You get the beginning of a cycle. One of the biggest signals this year came from Asia. Chia Cheng-hia, a well-respected veteran investor, increased precious metals from 15% to 25% of his family's office portfolio. For context, the average global family office holds just 2%. This reasoning was clear. Gold is part of lifetime savings, not a trade. And this tells us something important. The people who usually move slow are now moving early. Another trend is quietly accelerating, the vote flight. After events like the freezing of the Russian assets in 2022 and rising geopolitical risks across regions, wealthy Asian families have been shifting assets closer to home, and more importantly, shifting into physical gold. The logic is simple. If you hold physical metal, nobody owes you anything. It's not a promise, it's not a contract, it's a stored form of purchasing power. And here's something the public rarely sees. Major gold votes in London, Zurich, and Hong Kong have shown decreasing accessible inventory. At the same time, premiums for large volume physical purchases have widened significantly. When real deliverable metal becomes scarce, future prices tend to follow. This doesn't guarantee higher prices, but it changes the sensitivity of the market. Now, let's look at the currencies. Normally, during a risk-off episode, the US dollar strengthens. But last week, something unusual happened. The global equities pulled back. The bond yields moved. Risk appetite fell. But the US dollar weakened. And why? Because markets price in the possibility of more currency debasement. Not due to panic, but due to long-term fiscal realities. That's why gold and silver surged even as stocks fell. This year, we have seen tensions across several regions, including dispute over resource control and disagreement among global alliances. Whenever uncertainty rises, investors shift towards gold, silver, defensive assets, hard currencies. This isn't about predicting headlines. It's about understanding how markets react to uncertainty that cannot be easily priced. Technical analysts have also flagged that gold remains in a bullish acceleration phase. Recent moves include a breakout above key moving averages, strong RSI momentum, higher lows across Asia and Europe trading, and short dips that are quickly bought up. These are classic signs of the structural demand, not speculative spikes. One of the most underappreciated trends is how gold's demand center have shifted east. Higher income in Asia, growing distrust of traditional financial assets, cultural preference for gold, stable long-term accumulation patterns. In fact, a growing portion of intraday strength is now coming from Asia sessions, a sharp contrast to the past when US sessions dominated pricing. There's a difference between a rally and a repricing. A rally fades. A repricing happens when the world assigns a new role or value to an asset. Gold today is not simply reacting. It's being revalued. It's being revalued as a long-term store of purchasing power, a hedge against fiscal uncertainty, a safer alternative to long-duration bonds, and a natural asset in a multipolar world. Repricing cycle lasts for years, well, not weeks. So, what does all this mean for normal 9-to-5 investors like us? Here's a simple takeaway. Gold isn't about getting rich quickly. It's about protecting purchasing power. Silver adds volatility, sometimes opportunity, but gold adds stability. And stability is a strategy. Most investors fail not because of information, but because of behavior. They panic at highs. They freeze at dips. They try to time cycles instead of understanding them. But if the underlying fundamentals haven't changed, then short-term noise doesn't erase long-term directions. To stay grounded, keep an eye on 3 things. The currency trend. Are major currencies weakening? Central banks' behavior. Are they accumulating gold? And physical supply tightness. Are premiums rising? These aren't predictions. They are indicators that help you stay level-headed when markets move fast. So, is gold guaranteed to rise every week? Of course not. But is the long-term structural case stronger now than in previous years? Yes. And that's why many investors see 2026 not as the end of a cycle, but the early chapter. At the end of the day, you don't need predictions. You just need clarity. If you understand the forces at play, the flows, the behavior, the supply constraints, and the global shift, you'll make a calmer, better decisions that fits your own risk tolerance. If today's breakdown helped you to see the gold market with a little more clarity, remember to like this video and subscribe to Think Wealth 6789. I'm here every week to keep you informed without the noise. Thanks for watching. I will see you in the next video. See ya. Bye.